Yo, what's up you guys? Welcome back to another video. Today I'll give you guys an update on the market from both a technical and a fundamental perspective, and we're also going to talk about the CPI data that just got released. Now I know there's a lot of people who traded the CPI, but they don't understand, right? I just watched a video on Rydell's YouTube where US30 was telling people to buy the NFP because of the inverse between the dollar index and the indices, which is his way of forecasting where he thinks the NFP is going to go. There is a point I want to make there, right? There is a negative correlation between the stock market and the US30. Now, if you don't understand why, I'll be more than happy to tell you. The reason for that is that stock markets tend to weaken when the dollar index goes higher. Now, the reason for that is because it's due to buying power. What happens is that normally when the dollar index increases, it's due to high interest rates. Now, these high interest rates tend to put pressure on consumers. Therefore, companies that makes money through consumer spending, they tend to make less money. Therefore, the stock markets tend to get weaker. Now, if you flip that around, if the interest rates are kept where it is or it gets lower, that means consumer debt decreases, meaning they've got more money to spend, and because of that, we can expect the stock market to increase. However, that's not the way that you sort of looked at the NFP, but that's just my 2 cents that I wanted to put out there. So today, let's talk about the CPI. Firstly, what is the CPI? The CPI is the Consumer Spending Index, which is an indicator used by investors to measure inflation. Now, if you don't know what inflation means, it's basically inflation, right? We should all know what inflation is, right? So basically how this is measured is basically how this works. How this ties into the dollar index is very simple. When the consumer spending index increases, it means consumer spending are also on the rise, meaning that inflation gets higher. Now, whenever you see inflation increases, you can expect the Feds to also hike the interest rates. Why? Because the only way for the Federal Reserve to cool down, because the job of the Federal Reserve is to bring down the inflation. Now, if inflation goes higher, the Feds basically need to throw water over the inflation. What do they use for water? Interest rates. Why? Because higher interest rates discourages consumers to spend, and lower interest rates encourages consumers to spend. Now, when interest rates goes down, consumers are more flexible with their spendings because they got more money left after their deductions, right? Now, when the interest rate increases, more debt is then attached to the consumer, and therefore they have less money to spend, and then you'll see the consumer spending index will decrease over time. But I hope you understand that. For now, we're going to talk about what you can expect. Now, there is a massive correction coming. I don't want to say massive because then I sound like some very professional traders. So I'm just going to say that a pullback is expected in the stock market because, like I've said before, the stock market at the moment is heavily overbought. Although some very, very, very smart macroeconomic majors had predicted a stock market crash, and then someone like me who's got nothing said that it's not going to happen because of the actual economical data, as opposed to reading tweets that you see on Twitter by people who's also not very clued up with the information that you are. So now that we understand that, let's go through this article from CNBC. It says here the Fed to start cutting rates mid-year in 2024 with a high chance of soft landing. So you can see this article was published Tuesday, which is today, the 12th. It says here the Fed will begin to cut the interest rates in June, according to the majority respondents to the CNBC Fed survey. It says here respondents see a probability of a soft landing at 47%, but up to 5 points from the October survey. They lowered the probability of a recession in the next year by 8 points to 41%. Now, it says here the 35 respondents to the survey include economists, strategists, and analysts. The Fed decides on rates and gives economic outlook on Wednesday. Now, the one thing I do want to say is you can take this information with a pinch of salt, because anything that's got less to do with factual information and an article written by CNBC cannot be trusted or taken with the fact that you can say that it is going to happen, right? Because the only time that we can actually go with information that is given to us is when the information is factual, like the consumer price index that had factually just increased with 0.1% in November from October. It says here prices across a broad range of goods and services edged higher in November. There's energy prices decline, providing hope that inflation could be on a lower trajectory. So that's a good sign. Again, like I said, the Federal Reserve is fighting to tame down inflation. That says here the consumer price index closely watched inflation gauge increased at 0.1% in November and was up 3.1% from a year ago. The Labor Department reported Tuesday that economists surveyed by the Dow Jones had been looking for no gain, an early yearly rate of 3.1%. Now this is just a lot of reading as well, which is why I've explained it to you guys in the beginning of the video. Now we're gonna go through this. So we're gonna shift over to and then just do a technical analysis based off the fundamental analysis. Now, based off where I'm sitting, I do expect a correction in the market. You can see this chart I drew, I think was on Monday. I did this analysis. And everything still stands as it is. So the S&P 500, we can obviously clearly see we had a break above this level of resistance. We can expect a pullback now for the market to come back to test its previous level of resistance as support, and then from there we can definitely expect a continuation. Like I said, we are going into festive, and the market has a the market has got history for moving during festive, and it does normally become very bullish. So we're gonna just start with this move to the downside. This is what I am looking to get into here, which is this correction, and then we're going to start with the dollar index. Right now, firstly, we can see over here that the market, like I said before, I just completed this W formation to the neckline. We also got an inverted head and shoulders pattern, which is considered a bullish pattern from a technical perspective. We got structure over here where the market print support, resistance, broke above resistance, came back to test it as support once again. Like I said before, we do have the -272 lining up perfectly with the Fibonacci taken from the low to the high and the 61.8 Fibonacci retracement, that we can expect the market to continue higher and hit that level over there, which would make sense of why we'd expect the pullback on the S&P 500, and this will include the Dow Jones and the NAS100 there as well. If we go over to look at some gold, we can see a gold continue to rally to the downside, but we can also see that gold broke below a very important structure level over here that previously acted as a level of support, broke above that, came back, tested it as a resistance. The resistance didn't hold, the market came back, tested it as support, broke below support, and all of that supports now once again turned resistance. Now, because we expect the dollar index to increase in value due to a higher reading in the CPI, and not just that, purely because we expect a correction due to an overbought market there as well, we can expect some selling pressure coming through for gold, and the reason for that is due to the negative correlation in the market there as well. Next up, we've got the Dow Jones over here, the Dow Jones over here, the Dow Jones over here. Now we can see over here that is, I need to let me just use another US30, because that I'm busy doing a review on a signal group, so I'm using this US30 for that group. So let me just remove that and use this US30. So this now that we've established this over here, we can clearly see that the US30 over here also broken below this level of resistance. We can expect the market to pull back and hit it as support. One thing to keep in mind over here, right, the market is this market is a long way from home, right? The market here broke above this level of resistance. It never came to fill in the fair value gap, but it never came in to fill in it never came to pull back and come to test this previous level of resistance as support. I would probably say a deeper pullback is expected because of this heavily overextended market. I'd probably say we are probably going to go a little bit deeper on this market here as well. And then last but not least, here on the Nasdaq, you can see the Nasdaq finally broke out this consolidation phase that we have been waiting for. Like I said before, pullback expected. From there, I'll give you guys another update. Remember, we have a lot of news still coming through this week, so please trade cautiously and make sure that you manage your risk properly there as well. Now that is it from my side, guys. Thank you for your time, and as always, cheers for the ears.